Hey, everybody. Welcome to CRE Power Hour, hosted by the dynamic duo of commercial real estate, myself, Lisa Marie Wand, and the amazing one and only Stephanie Gillison. And with 4 decades of combined experience and expertise, we've built and we've scaled and we've conquered the real estate world. And we're here every second and fourth Wednesday at 11 a.m. Pacific to bring you the top guests from the commercial real estate field. So tune in for the insights and stay for the success stories. This is CRE Power Hour, and Stephanie's going to introduce our guest today.
Lisa Marie, I'm so excited about this because over the course of the 2 years we've been doing this show, we always mention, I think on every single episode, how you have got to stack your tool belt with the right tools. And by goodness, in 2023, I found a killer tool that came from a totally different perspective as it relates to taxes, but also when you apply it to investments or business sales, valuation, and so forth. Look, us as real estate brokers have been missing a huge benefactor. We titled this today, How to Help Your Clients Get the IRS, 50% of the IRS money to buy investment property. Well, that's what James Harnsberger is here to do. James is out of San Diego, California. However, he is an enrolled agent servicing the entire United States. He's done a little bit of work outside the US as well, but primarily here in the US. And you're not going to want to miss this all. James, thanks for coming on board. I know you are a super busy guy because you are in it to win it. And the loser is the IRS, right?
That's nice Absolutely. To hear for a change.
Yeah. And you know, you make a very good point. I mean, that's the name of the game is winning and losing. It's not about, you know, playing nice or playing rough or anything like that. At the end of the day, if you can't win, then you're going to be giving up a lot of your wealth in unnecessary taxes that are just crazy. It's insane what people are doing.
James, you're an enrolled agent and a CBA. I want you to explain to everyone what exactly that is, because it's more than what it appears.
Yeah, so an enrolled agent is actually someone who has passed successfully all 3 bar exams to be admitted to practice before the Internal Revenue Service in all aspects of federal tax law. Criminal tax law, civil fraud, corporations, partnerships, LLCs, sole proprietor, collections, enforcement, fraud investigations, appeals, amended returns, tax preparation. Every aspect of federal tax law is required. And then you have to take these 3 admissions exams to be admitted to practice, and then go through an extensive financial background check, because this is all run by the Department of Treasury and the IRS. And so
that sounds exhausting.
It's a hill. We're not just tax preparers or return preparers. I mean, we do tax preparation, but more importantly, my job and most of my expertise is in the business reorganization, small business, commercial real estate, multifamily, investor, and crypto. My big specialty in the tax side of it is IRS appeals. I handle all of the large dollar cases. So if you, like a recent couple out of Las Vegas, they owed the IRS $3.7 million. I took the case on appeal and reversed, after about 30 months, we reversed the 3.7 million down to 0, and we clawed back from the IRS about 700,000 that the IRS illegally took, and then they had to pay the interest on that back to the client.
Oh, and you're now everyone knows why James is my hero, right?
You're my kind of guy, James. I like, this is sexy tax talk right here.
So
yeah, it's like giving the IRS a spanking.
Well, and I'm going to come from my story too, because look, when I first heard some of the things that were coming out of your mouth, James, I scratched my head and said, all right, I better do some Googling, because It sounds like to me what he is saying is going to get my ass thrown in jail. But it's not. It's not that way at all. But there's so few people that I have found. I've had the highest paid CPAs. And if they're watching, I apologize, but you're fired. I've had the highest CPAs for the last 15, 16 years. I have paid an astronomical amount in getting my taxes
Yeah.
prepared. Not only am I a real estate broker, I'm a developer, I own a building company. There's a lot of different income that's coming in. And I'm paying
Right.
substantial amount of taxes every single year when I hear other people aren't. I'm just like, how is this happening? But, again, it's because we're not educated properly, or we've hired people that just want to send us a bill and prepare taxes and push us off to the next. And since knowing
Right.
you, we're going through a lot of restructuring to where I will have more wealth, because this is about building wealth. And I think that aha moment when I met you was when you were giving a conversation, a speak just like this, and we were educating other real estate professionals on stop looking at the property valuation as it's based on the income or comp approach. Let's look at it from the tax approach of building wealth. And we've had success stories there, but kind of go into that a little bit so the audience understands what the heck it is we're talking about.
You make a very good point, Stephanie. And I think the easiest way to explain this is how you set up your property or how you set up your business is going to decide how you're going to be taxed. So when I'm looking at a business valuation, or I'm looking at a property valuation, or I'm looking at a compensation analysis valuation, what I'm looking at are the hidden and never revealed tax attributes of the transaction. Let's say that you're a real estate professional. You've got a client that's got commercial property, and they're looking to sell that property. How they hold that property and how they dispose of that property is going to decide how they're going to be taxed. If they're holding it in a certain way and they've held it for 5 years or more, there's a provision in the Internal Revenue Code that would allow us to exclude up to 50% of the gain, up to $10 million tax-free. But nobody ever looks at that. And so they've got a $7 million gain on a big commercial property, and they get forced into 1031 because they don't want to pay the tax. And you don't have to do a 1031. If you had this set up the right way, and we can look at that, and you're eligible to make that election, 50% of your gain up to $10 million will be tax-free to you. The same way I'm looking at valuation. I've unlocked tens of millions of dollars in hidden value by going back and looking at the tax attributes that nobody's paying attention to, and make a crappy deal actually turn out to be a good deal once you understand the tax attributes. So it's really the tax is the driver and wealth is about accumulating and adding more to what you already have. Getting rich, anybody can get rich, but it's the few people, that the small percentage, that build wealth by understanding accumulation. If I have one apartment building, I want to add another apartment building and accumulate. And that's the principle that the tax attributes really drive. Because if you make $1 million, but you only keep 200,000 because you've got all this tax exposure, then you're not going to be able to accumulate. And so our job is really to understand those dynamics, decompose the financials, and then restate the financials with the tax attributes pre and post tax, so that the investor, the real estate professional, you, Lisa Marie, all understand where that true value is really lying.
And I love that, Lisa Marie. Here's, we've had a multitude of scenarios ever since I've met James about how, one, for example, was a retail strip center. Okay. And look, the rent was okay on it. It was fully occupied, rents coming in. Rents could have been raised, but not in the situation where the leases were already locked in place. You know, it was going to be another 3.5 years before you could see those rents get up to true market value because the seller was a very nice landlord. However, when James broke it down for my client and showed him the tax savings he was going to have each and every year on top of the income, it made sense for him to go ahead and buy when we had already had 2 or 3 buyers pass on the opportunity because they didn't see it from that modelization.
Exactly.
Well, and as real estate brokers, you know, we're always told to stay in our lane. We're not attorneys, we're not CPAs. So having a partner like James who can actually speak to a specific deal or a specific business is great because we are really not supposed to do that.
Right.
And so having the right partners, and you're also talking about, it sounds like, James, that the entity within which the business or the property is held is going to have tax ramifications before, during, and after a sale. Is that correct?
Yeah, you make a very good point, because if the entity organization or the structure of the entity is not aligned or congruent with the financial objectives or the tax centric objectives, then it won't matter, because your entity is so inefficient that you're overexposed to the tax side of it. And so we go through a process that is basically a reorganization or small reorganization plan, sort of what we're doing with Stephanie. And we take what you have and reorganize it so everything is tax centric, financial centric, and congruent to the financial objectives that the client has. Once we have that, then we can bring about all of the efficiencies, and your internal rates of return and your yields are going to, sometimes go up 4-5x, because if you're not paying the taxes that you've been used to paying, and we get to add that back to your return, all of a sudden a 9% return or yield turns into a 19% yield, because we add the tax savings and the tax attributes back to that. And I can tell you, commercial properties that have been used to paying $200,000-$300,000 a year in tax are paying zero tax now, and recovering all those dollars that they've overpaid for the last 3 or 4 years, because their entity wasn't set up in a tax centric or financially centric manner to allow for those efficiencies to be utilized.
And so, especially with the climate in lending, interest rates, and commercial real estate in general, having that higher rate of return when something else on the market doesn't can be a game changer. Because, Stephanie, I have a very similar situation to what you were talking about with a retail strip center. And so this type of tax advantage could determine whether someone can buy or sell a property. And that helps everybody. That's like a win-win-win. And then what about, James? Does the IRS allow you to, so when you do a reorganization of an entity, how far back does the IRS allow you to go with that reorganization in order to review the tax structure again?
That's a great question. So the reorganization is a demarcation of today going forward. The IRS allows us to go back the last 3 years of tax returns that are filed and do administrative corrections for errors and omissions or misstatements of the most common mistake is the allocation of the asset groups and depreciation, or the miss opportunities in the timing of how income is recorded. For example, let's say you're a franchise owner and you have, maybe 10 Burger King franchises, and you look at your financial statement, and all of a sudden what we find employee meals being marked off at retail, which is not accurate. And the gross receipts include the sales tax, which means when your profit falls to the bottom line, you're paying tax on a portion that was sales tax.
Yeah.
So we go back and we restate the financials, ex tax, We take the actual employee meals and manager meals that can be somewhere from 3 to 4, maybe 5% of gross. We restate those at the cost of goods level. We take the tax attributes of the equipment and the fixture depreciation. We restate that. And all of a sudden you have a financial profit of 350,000, but you have a taxable loss of 700,000.
Wow.
Phew. It just works though.
So you
That's
get
all
to
I
keep the
know.
money, but you don't pay any tax.
Yes. And you know, Lisa Marie, going back to your similar situation with your retail center, you know, I had so many buyers on properties where they were so hung up on that interest rate, right? They were so hung up. Oh my God, I can't pay 8.5% or 9% or whatever the case might be. And you know, when James was able to show them the modeling of the tax savings, and share that, James, because that's a wow moment right there that got people's eyes wide open.
You know, 8.5% interest doesn't matter. It really doesn't matter, because what matters are what is your yield and what is your internal rate of return and your ROI on your capital, right? So you take the property, commercial property, and we analyze. There's two components that we start with. We start with the land and we start with the building. We take the land. Land is not depreciable, except we take the components on the land, the trees, the shrubs, the parking lot, the sidewalks, the irrigation, the fence, the light fixtures, the light poles, the signs, the stripping on the parking lot, the asphalt, the curbs. All of those components that are on the land go into a bucket called 15-year property. And those are depreciable assets. Then we take the building and we separate the building into its components. How much is 5-year property? How much is 7-year property? How much is 15-year property? And whatever's left goes into 27.5-year for residential rental or 39-year for commercial on the residual. What we do is we front load the depreciation so that you're getting the most and not having to be subject to the recapture rule by using the straight line method. We give you a much better yield. You're paying less tax on the income. You're getting those tax attributes, and you're not suffering the tax trap when you sell the property in 10 years where you have to recapture all that depreciation, because we didn't use that method of depreciation when we did the cost segregation. Then the next component is we look at the rents and we do a comprehensive rent survey, which is a valuation approach to rent. And we can show you per square foot how much money you're losing per square foot of rentable space by taking your rent approach in the way that is an outdated model, and give you an updated model on a rent survey so that we can show you that there's a more cost-effective way to do your rents. You actually make more money and pay less tax and have more money in the bank. And when you sell the property, you're not going to have the tax trap of the recapture of having to pay tax on the depreciation that you have to add back to your capital gain.
So part of it is looking at cost segregation from a different model, because, you know, a lot of people will take, we've had, remember, people at EXP Commercial where they do all this front loading of all the cost segregation to give you all the savings like in the first year or two or so. And so this is a piece of it, but it's a different model. Am I correct?
It's a different model. Yeah, it's a different model because let me give you the next chapter in that design. The typical design is you would have a closely held specific purpose corporation set up to be a C Corp or an S Corp. Then you set up a limited liability company that's going to own the property. Now, the property is held in an LLC. You and the corporation become the managing members of the LLC. Now, when you have that entity structure, the LLC is a partnership. It's never going to have taxable income because the disproportionality rules of an LLC allow a 5% shareholder that's the corporation, to get 95% of the profits and losses. Those all go up to the corporation, so there's no taxable income at the partnership level. Now, to give you an example, my wife and I own a 5-unit property over on Mohawk. We bought the property next door on the corner of 72nd and Mohawk 2.5 years ago. We went to the city because we thought we could build 2 duplexes. The city said, no, you can't build 2 duplexes. We'll let you build 14 units. So we scraped the lot down to the dirt. 2.5 years later, in December of last year, we paid $577 for the lot and put $50,000 into it to scrape the lot. So we had $630,000 in the property. Last year in December, we sold it for $1,250,000 cash. We had it listed for 8 days, and we got a buyer full cash, 30-day escrow. And the LLC got $1,250,000 in cash. The LLC will file a tax return with a $54,000 loss. All of the cash went up to the corporation. The cash in the corporation now, how much of that $650,000 of taxable gain? Well, we're not going to have taxable gain because my wife took a $250,000 salary and made a $250,000 contribution to her defined benefit plan, which is creditor proof. Nobody can ever touch it. So we got a $500,000 deduction that I don't have to fund until October of this year. So I get to have the cash working for me in U.S. Treasuries at 5% a month or 5% a quarter. And that cash sits there working, and I have no tax liability when the corporation files its return because I get to write off the defined benefit plan and the compensation plus the $50,000 loss. And I had actually, when the dust all settles, I had a $26,000 net loss on that transaction.
And I am like, why couldn't I have met James 20 years ago? Damn it. Damn. I mean, but you hear that story and you're like, holy crap. Every real estate broker should at least be able to say 3 things. Or 4 things. I want you to talk to James, or 5 things. I want you to talk to James, right? Because think about this. How many people may have not sold that property because what are they going to buy on a 1031 tax exchange, right? Thinking that there's no way around paying those gains.
Yeah.
Think of how easy he makes that sound.
Right.
Well, it sounds complicated.
You just reorganize. You have a management corporation. It sounds complicated, but I got to tell you, it's really not. A closely held specific purpose corporation is easy to form. The LLC is easy to form. You create a management conduit agreement between the two. The corporation becomes a partner in the LLC as a managing member with you. So you get all the protections. Now you've created a partnership. So partnership rules apply, not LLC. LLCs are disregarded unless you make tax elections, right? So we would preserve the stock of the corporation to be qualified small business stock under Section 1202. That means if you held that stock for 5 years and you sold everything for $10 million, we would take the position, since you had qualified small business stock under the reorganization plan, 50% of your $10 million gain is going to be tax-free up to $10 million. You're not going to pay tax on the first $5 million of that gain. I just saved you $2.5 million in tax.
So that's really interesting about setting up the S Corp as a partner in the LLC, because normally, let's say, so I have an LLC also and an S Corp, and the way that I understand it with my CPA and also with clients is the S Corp doesn't have the tax liability, the LLC does, or the individual. And so you're saying it in a totally different way.
Well, your tax liability from an S Corp, if you had $1 million in profit passed through to you from your S Corp and you didn't take salary and compensation and you got audited, the IRS would disregard your S Corp, treat you as if you were self-employed for tax purposes, and you'd get a big penalty on top of the big tax bill. And then you'd need to hire somebody like me to appeal that and overturn that decision.
Yeah. So you definitely want to pay yourself a salary, which we do. So yeah, but it's just interesting to
And
hear.
so you got to understand what reasonable compensation, reasonable compensation. And as a valuation analyst, my specialty is compensation analysis so that you can do that. Look, when you put $250,000 in a retirement plan every year, 100% of your salary up to $250,000, you get a deduction for your salary of $250,000, and you get a deduction for your contribution to your defined benefit plan. Creditor proof, it's protected. If a creditor can't attach your defined benefit plan, neither can the IRS. Ask O.J. Simpson. When he got sued and lost the lawsuit for wrongful death, they couldn't touch his NFL retirement plan because it was in a defined benefit plan.
Yeah. Yeah, that sounds like a big key, and a piece that a lot of people are missing. So that's great.
Yeah, so we take that gain and we characterize the gain. Now you've got it in a defined benefit plan. Now, you really want to get sophisticated? You can use your defined benefit plan as a lending tool and turn it into a lender to start loaning you money on your real estate deals. You can self-direct your defined benefit plan. You can act like the bank instead of using the bank. Now, do you really care if you're paying 8% interest since you're making the interest? And if you really want to take the next step, we can decouple the defined benefit plan on a 3, 5, or 7-year Roth conversion so that you never pay tax when you convert it to a Roth by using depreciation in real estate to offset the taxes that you would have when you convert your retirement to a Roth, and then it grows tax-free. Planning. Wealthy people are wealthy for a reason.
I know. Lisa Marie, did I not tell you you were going to love this conversation? I mean, I've not stopped smiling since I met James last year, and I'm just so excited. And the day that he told me, Stephanie, we're turning you into a bank, I'm like, okay, because that's exactly what we need to be doing. Why go borrow other money when we can put all these tax savings aside and then borrow it back for ourselves, right?
Oh, that's amazing.
And, you know, one of the things, and again, we don't talk politics on this show, but I think it was the first or second private conversation that James and I had. I said, by any chance, do you do Donald Trump's taxes? Is this who this guy is? Because that was Ben, you know, everyone's always wondered, how in the world has he not paid X amount of, you know, millions upon millions in taxes? But it's because he was structured and set up appropriately the first time, right? Or, you know, when he started getting into
he's got $2.2 billion in tax losses from cost segregations on casinos. It'll be 10 years before he uses all of that up and ever has any taxable income. There's a reason that people are wealthy, that are wealthy. There's a reason why they're wealthy. They have mastered the ability to keep more of the money that they work their ass off every day trying to make, get the government's hand out of your pocket, pick in your pocket. Every time you turn around or bend over, you got somebody's hand in your back pocket. So I love getting up in the morning with the idea that I'm going to give the IRS a spanking today, and I just need to get a good belt and get ready to give them a spanking.
So, James, I just love that visual, giving the IRS a spanking. That's awesome. So, tell me, how come, just, you know, theoretically, how come more CPAs and tax professionals aren't helping people structure their life? Because really, this is your life. It's your business, but it becomes your life because now it changes your life because you get to keep more money instead of being, like Stephanie was saying, on the hamster wheel. Why is this not more prevalent?
So let me answer it this way. How do you know what you don't know? And that's the problem with the tax industry. And over the last, I've been in this business in practice for 4 decades, and I can tell you that every year it gets a little bit worse in terms of the number of people. 20 years ago, we had 1,300,000 tax professionals in the country. Today, we have about 600,000. Most of those were baby boomers, so they're retiring or they're dying. and they're turning age 65 at a rate of 11,000 a day for the next 15 years. So this population shift is going to radically transform a lot of professional industries like accountants and tax professionals. The average tax professional or CPA only has to maintain 15 to 20 hours a year of continued education. So it's like water. They're going to follow the path of least resistance. I'm a little bit critical of the industry because people are intellectually lazy and don't challenge themselves or don't set higher standards. And the model of setting up a practice to do tax prep, I stopped charging clients to prepare taxes 15 years ago. I figured out you can't make any money filling out forms for people. So I do that for free. My firm does that for free because there's no money to be made in it. My value is helping you keep $100,000 more every year so that you can invest in and put that capital to work. And I get paid for the time that I work on that. The second part of that is that the client doesn't know what the client doesn't know, because and Stephanie's a good example. My accountant told me I couldn't do that. Well, that's because your accountant doesn't want to admit to you that they don't know what the hell you're talking about when you mention something like this. Did you know you could set your corporation up and your corporation could give you a car allowance and you could drive an S550 Mercedes like I do or like my wife does and have that fully deductible and not keep a mileage log? Did you know your corporation could give you a home office reimbursement and deduct it at the corporate level and you don't have to report that as income on your personal tax return? The same with your medical insurance, your over-the-counter medication, your business meals, your entertainment. All of these things can be done if you have the right planning model created and your corporate structure is set up in a way that allows you to do these things. But what does everybody do? They go to LegalZoom.com, they form a corporation, they give you the corporation, they charge you $1,500 for something that they only pay $200 for, and they don't give you an owner's manual of how to use it, and they don't know half of the stuff that they can do or half of the stuff that is allowed to be done. And so they think that the money is to be made by charging you $4,000 or $5,000 at the end of the year to do your taxes. Keep your $4,000. I'll do your taxes for free, but let me save you $250,000 over the next 2 years by setting your business up so that it's tax centric, financially centric, and you have a wealth mentality to accumulate wealth.
That's right. And I'm going to chime in here, Lisa Marie, because, I have had a very, top-notch, supposedly very expensive CPA firm for 16 years. And I always have been on the defensive with them. I have argued every single year saying, no, I've heard I can write this up. I know and no, I mean, it was like, no. And finally, I'm one of these people where, look, I don't relate to no. So when I'm doing the research, I would find myself researching on IRS.gov and then highlighting and sending back over going, here it is. I knew this was a possibility because they had told me, they said, yeah, Stephanie, you can write off your car, over the course of the next 3 years, but not a luxury car. And all your cars are too luxury. And I'm like, that's bull crap. I mean, it's, and so James, that's why he's gone back and I've paid a lot to the IRS, but he's reorganizing and redoing some of that because they didn't allow me to write off certain things that I should have been able to.
Yeah.
And I knew, but here's the thing. If you're like me, which I think a lot of us are, I work nonstop. And the person that I take care of last is myself.
Yeah.
And that's why I wanted to have James on here today, because one, it helps all of us independent contractors get our stuff together, get our wealth plan in order so that we too are,
Right.
able to share our experiences with our clients.
Yeah.
And even before going through this process with James, but I was already learning from him, we already started getting clients on phone calls with him. And in 8 minutes, he was able, we had a buyer wanting to buy a multifamily property. And again, rent, interest rate was the hang up. It took James 8 minutes in a phone conversation for the guy to sign the purchase agreement.
Yeah. Well, and
I
it's
never met the
interesting.
guy. I never
Yeah.
met him.
But he spoke to him in a level that I couldn't speak to, which is all about these tax savings, these tax benefits that he needs to add into the entire pot of gold, and not just look at the interest rate and not just
Well,
look at the
what we showed him is I ran the numbers through a worksheet that I created. He gave me the numbers for the deal, and I worked out the numbers. And I said, look, in the first 5 years, if you're going to own the property for 7 to 8 years, the first 5 years, your tax savings and your free cash are going to equal 81% of what you're paying for the property. In other words, the IRS is paying almost 65% of the cost of that property. Why would you, if you don't buy it, I'll buy it.
Yeah.
Because that's a good deal. He said, what do you mean? Let's do the math. Your tax savings that you're going to save for the first 5 years, add that up. And we got a number. Then your free cash that you're going to have left because you're not going to be paying taxes. Let's add that number. Add those two together and subtract it from the purchase price. Your $1 million property is only going to cost you $301,000 because the IRS is paying for the rest of it with all these tax savings. Why would you not do that? And in 5 years, it's going to almost double in value. And when you sell it, you're not going to have the big capital gain because you're going to have a management corporation where all that money is going to go up. And you're going to stash it away in your defined benefit plan, not some bullshit 401k, which is now worth 201k because the stock market ate it all up and you had to pay tax on it.
James, we need more advocacy and advocates like you, especially as independent contractors and as people who are investors and looking to grow their wealth. I mean, this is just a piece of the equation that's been missing. And, my wheels are turning and I'm just like, I've had dealt with the IRS and I've done what Stephanie's done, where I go and do the research myself because it's conflicting. And then when I call or anyone calls the IRS to talk to one of their agents, they don't help you.
No.
In fact, they go out of their way to not help you. They could just say, if you filled out this or you did this or whatever, but they don't do that. So having an advocate, having someone in your corner, which is how I look at you, James, is so important.
Right.
And having a person that not only understands everything to do with the IRS code and taxes and all of these things and how to set us all up and our clients and so forth. But what I love most about James is he understands real estate. He started out in the real estate industry, which puts the sprinkles on the cupcake because he speaks our language, which a lot of CPAs and accountants and so forth, they haven't lived in that. And so that helps out tremendously. And then James has an entire team.
And my wife is a current real estate broker and we're active investors. Yes.
Yeah. And James' entire team of people that he's mentored in his firm, they're all sitting with the same expertise, which is tremendous as well too. And so here's what I love. I love that we had you on to James. James, I'm your biggest fan. When I get all that, when you get me all that money back from the IRS, I'm gonna fly out to San Diego and kiss him on the lips. And my husband said he was coming and going to do the same thing. So we'll have to air that
on each side.
On this show. We'll air that live on this show. But look, I love this. I have been hit with so many messages saying, send me James' contact information. Send me James' contact information. Here's what we're going to do, everybody. On the LinkedIn post, on the Facebook post, on YouTube, in the comments, we're going to put a link to James's calendar. But I'm also going to put a link for you to register because every third Thursday in the evening, well, it's 7 p.m. Eastern time. So that's 3 or 4 p.m. Pacific time.
Yep.
He does what's called Third Thursdays. And what's cool about Third Thursdays is I can jump on his Zoom, And he's telling us what is happening in the real estate industry, the mortgage industry, the tax industry, all of that. He goes through his slide deck. He runs through the spreadsheet. He does modeling for you. And my favorite thing is not only can we show up and continue to learn from James, but we can actually get our clients on that. And I have actually done that. Several of the brokers and agents that I work with have done that. And it has been a game changer. We had a real estate broker in Chicago, Illinois, sell 3 properties already this month because she was smart enough to bring James into the equation. And so look, this is our second show of 2024. I wanted to make sure with Lisa Marie that this year is the year of value. That is what we're bringing. If you're not tuned into this, well, we're just going to beat you to the punch and take all the deals anyway, right?
That's awesome. James,
And
you have
just
so
to let
much
everybody know, there's no cost. There is no cost to any of this. I give all of this because I want to give back. I feel that my life has been so blessed with my beautiful bride of 18 years and all that God has blessed my life with. And I want to give a lot of that back, especially to the men and women in the real estate industry that have had a lot of gut punches over the last 10 years. If there is something that I can do in an engagement that will help you execute to the next step, I'll give you an engagement. We can talk about that, and then you can hire me to work. But other than that, the consultations, the worksheet, everything is
Thursdays,
at your disposal, and there is no cost for it. I just enjoy so much what you're doing.
Awesome.
Well, you're our kind of people, because Stephanie and I are here to give back to the commercial real estate and the real estate community. And so you fit right in with us, and I'm sure we'll be having you back on the show to talk about more.
We're going to have an entire series this year, James, at least once a month. You got to come back on CRE Power Hour, and we'll keep escalating it up and up and
I'm
up.
happy
And
to do that.
Next time we'll do the worksheet. We'll run some models. Lisa Marie, you bring a property, I bring a property. We'll run the models and we'll show everyone exactly how all that works. So in the meantime, though, in a few, check the comments. We'll get the links uploaded so that you can get on James's calendar and reach out to him. And then we'll also have the link to his third Thursdays. And the next third Thursday is tomorrow, or was it last week? No, is it tomorrow?
That was last week. Yeah.
Oh, it was last week.
So
it'll be in the next one will be in February, but when you click it, you'll see the date and time on that. So James, thank you so much. You and I will be talking even more. We always do. Thank you so much for being on the show.
See you again.
My pleasure,
soon.
ladies.
Thanks, everybody.
All right, ladies. Nice to meet you. All right. Take care.
Bye.
Bye.